What's up, everybody? We are live. Let us do this. Okay, so today we are going through one of our first live sessions in a while. My apologies. It's been a crazy year for us with some ups and some downs, and we've been doing a lot of hard work. As you can probably tell, you've seen the channel growing. We've been doing a lot of content, so that's very exciting. And it warms my heart to be able to be live with you guys again so that we can work through content and some materials and stuff like that. So, today's topic is going to be all about the Truth in Lending Act. Specifically, will help you on two different types of examinations. Number one, I am a real estate instructor for many, many years now, help thousands and thousands and thousands of folks to pass their examinations. I hope I'm helping you guys pass from the comments that we're getting on the channel and all of the students that I've taught over the years. I'm fairly confident that people are passing and doing well. So check out our content, keep watching, keep tuning in. It will help you to learn this stuff. It is also going to help you if you are taking your mortgage loan originator's licensing examination as well. And for that NMLS examination, this topic is also on there. Now, in the NMLS exam, it is going to be much deeper and a lot more in depth. They're going to be looking for a lot more granular concepts. For the real estate examination, folks, it's going to be some key points to understand, and that's about it. That's all you're really going to need to know to be able to get through it. All right, so thank you once again for all of you subscribers, and if you know somebody that wants to are studying for this exam or thinking about it, ask if they could subscribe to our channel and check it out. We're growing and growing and growing, and it's awesome. It's all because of you. So the intention here is I'm going to go through this Truth in Lending Act. We're going to go through some key points. We're going to go through some materials. It's live, so things could go wrong. So we'll see how it goes. But we should be good to go. I've got some vocab that I want to go through with you, sort of flashcard style, and then I want to go through some questions at the end of it, about 5 questions that are really good questions to help you sort of get reoriented with the content as it applies to the examination. I'm flying solo today, so you gotta, if you have comments and if you're actually making some comments live, then I will get back to you after the stream is over. I figure we're gonna be here for about 45 minutes or so-ish, and we'll go from there. All right, let's get into this. So the Truth in Lending Act is something that you're going to see in your finance sections inside of the textbooks that you're working with and studying for. Now, in the mortgage finance sections, really Truth in Lending Act is simply a consumer protection law that is designed to help bring some transparency and some protections to consumers as lenders in the business of lending might err and make mistakes or might purposefully make some misrepresentations, and then they need to get checked for that. So this is a consumer protection law. Now, the first thing out of the gate that you want to know is there's a couple of bullet points. So Truth in Lending Act is also referred to as Regulation Z. So let's kind of get to my notes. Let's go into those. And if you have questions, kind of chime in, but I'm going to kind of go and talk about the things that I think you're going to typically see on there. So let's just jump in to these notes and let's go for it. Here we go. So with some key discussion points, purpose of the Truth in Lending Act, the first things first here that we want to know is that it protects consumers by requiring clear and consistent disclosures of loan terms and costs. We call the Truth in Lending Act Regulation Z. So sometimes on examinations, they will refer to it as Reg Z, or it'll be named as Regulation Z on one of the answers. So look out for that. It's one and the same. It's sort of the way they'll refer to it. Now, Regulation Z actually implements the Truth in Lending Act. So it's the implementation arm of the Truth in Lending Act, and it covers credit transactions, including mortgages, credit cards, and installment loans. So it does include all of these consumer direct types of financing transactions. It's not applying to commercial lending. It's applying to residential transactions to consumers that are, for sort of residential purposes. Now, some of the key disclosures as required with something called the TRID rule. And you see what happens, kind of taking a step back. 2 laws sort of got together, and they're both consumer protection laws, one of which is something called TILA, which we're working on now, TILA, Truth in Lending Act. And then the other one is something called RESPA, which you are also going to see on your exam. We'll cover RESPA later in another live segment. But RESPA stands for the Real Estate Settlement Procedures Act. And what these two laws are is they're consumer protection laws. And together, they have a fair amount of disclosure language. And what they found is that there was a lot of sort of overlap and a lot of confusion. So what they did was they came up with this sort of middle ground called TRID. And TRID stands for the TILA, the T in TILA. The R is RESPA. TILA, RESPA, integrated. The I is integrated, and the D is disclosures. So TILA, RESPA, integrated disclosure statements are what we have. And there's some disclosures that consumers have to receive as per the TRID rule to be able to do certain things. Number one is a document called the loan estimate. Number two, we have something called the closing disclosure, and we need to know that these two documents exist when it comes down to these examinations. Now, on the mortgage originator's examination, my suspicion is that they're probably going to want to know a lot of in-depth questions about those specific documents, like disclosure timing and things of that nature. But for the real estate examination folks that are studying for that, you only have to kind of stay at the surface level. You don't need to know very much. And what we have here in terms of notes should be relatively sufficient to get you through the examination. So there's two documents. So again, TILA is the Truth in Lending Act, also referred to as Regulation Z. Then we have some key disclosures. We have, according to the TRID rule, the TILA RESPA Integrated Disclosure Rule, we have two documents. Document number one is something called the Loan Estimate, or the LE. Document number two is the Closing Disclosure, or the CD. By the way, we have other videos on our channel, and they're going to show you illustrations of those particular documents. I go into them in a lot of our questions, and you'll see them. So go check out those videos. We'll put a link in the description so you can kind of refer to those particular videos where you see those. But you just want to kind of know what they look like. Now, for the exam, this is what you want to know. You want to know that the first thing, the loan estimate, what is it? It's a document that we give to a consumer when they apply for a mortgage loan. So when you apply for a mortgage loan and you give your loan originator or loan officer a couple of bits of information, things like your name, your social security number, the amount of credit being sought, the purpose of the credit, and the ability to pull a score, the property address, these bits of information are enough to be able to trigger taking an application. When that event takes place, according to the TRID rule and by law, we have to, in the loan business, give a loan estimate to the consumer. Now, all it is, it's like an estimate when you hire a contractor, you're about to hire a contractor. It just kind of says, based off of my experience, this is what's going to cost, and this is what the services we're going to provide, and blah, blah, blah. Well, for the loan business, we have to be able to disclose those bits of information. So, and that's what's going to happen with this loan estimate. It is an estimate. Now, it's not like a loosey-goosey estimate of, it's going to cost you about this much. This estimate needs to be fairly accurate and pretty specific. And in some instances, it needs to be 100% accurate as to what you quote the lender to what they're going to charge the consumer. Now, things can change here and there are certain tolerances for these documents. You want to know that within 3 business days of the loan application, this loan estimate must be given to the consumer or placed in the mail, no later than. So just remember, loan estimate, TRID rule, 3 days. 3 days from loan application. That's it. 3 days from loan application, loan estimate. Now, 3 days prior to closing the transaction, let's say if you're buying a home and you're borrowing money, let's say if you're refinancing your home, any of this stuff, then there's a second document that we need to know about called the closing disclosure. By the way, sometimes on exams, they refer to these documents as LE and CD, loan estimate and closing disclosure. All right, now the closing disclosure has to be delivered at least 3 business days before closing. Now, you can call it closing, you can call it consummation, you can call it settlement. Reality is the law states it's called consummation when the loan is fully consummated and is the legal responsibility of the consumer. But if you remember CD and 3 days before closing, you're good to go. So there's 2 documents that have to be given out: loan estimate, closing disclosure. Now, another key component of the Truth in Lending Act is something referred to as the APR, annual percentage rate. You want to know a basic definition. So here, let me read this one. It reflects the total cost of borrowing, including interest and fees. It is an expression of the interest rate and all of the finance charges that are rolled into the cost of borrowing credit. Things like loan processing fees and application fees and these types of charges are all kind of rolled into the APR, and it's expressed. So the APR for an interest rate, let's say your interest rate was 5%, your APR might be 5.276. And that's expressing to the consumer, hey, listen, this is including all of these charges that we're representing. And that's how you compare banks, by the way. You don't call up 10 banks and say, what are your rates? They're all going to be relatively the same, if not spot on the same number. The question is based off of the rates that you're offering in the market, what are your APRs connected to these rates? And then Bank A can give you their APR for like 5%, and then Bank B can give you their APR for 5%, and you will be able to see the difference between those two. One might be 5.268 APR, one might be 3.715, 5.371 APR. So the one that has the higher APR costs more than doing business with lender A in that example. So that's how you check that. Now, the APR has to be disclosed. It is the only number that doesn't prompt other clarification. So if you're driving down a highway and you see a billboard for an interest rate being advertised and it's like 5% fixed 30-year fixed mortgages, 5% at Bank A, well, then that's not enough. That billboard must also contain the APR. It's a trigger term. Now, the APR can stand alone. So if you're driving by that same billboard or a couple miles down the road and you see another bank and they're saying 30-year fixed mortgages starting at 5.278 APR, that's all you need. So APR can be completely disclosed and stands alone. For you mortgage loan originators, you definitely want to know that. For you real estate folks, you want to know that APR is the true cost of credit and what it stands for, the annual percentage rate. All right. There's another note here. When we are refinancing our home loans, Truth in Lending requires a lender to give borrowers something known as the right of rescission. Rescission means giving the borrower 3 business days to cancel refinancing and home equity loans. This does not apply to purchase loans. Now, if I were writing a test question, I would want you to know that. I want you to know that the right of rescission is a 3-day right of rescission that does not apply to purchase loans. All of the following are covered under the right of rescission, except that could be a style of question that you see. So that's something that I would want to know about the right of rescission. All right, so right of rescission gives you 3 days to cancel. The word rescind, to rescind means to cancel. Now, the difference in contracts between a rescission and a cancellation of contracts is that with a cancellation, you don't get all of your money back and everybody doesn't start off at square one. With a rescission, everybody goes back to square one as if this thing had never taken place in the first place. So you want to know the difference between a right of rescission and what is a contract cancellation. That would be helpful for courses as well. Now, Truth in Lending also deals with something called advertising, and it's called the Truth in Lending Act, so it goes hand in hand with advertising. It requires clear and accurate advertising of loan terms, including triggering terms like we talked about earlier, and APR disclosure, annual percentage rate. So let's just sum it up real quick. Truth in Lending, Regulation Z, boom. It has some requirements known as the TRID rule, where physical paperwork has to be given to consumers when they're applying for a mortgage loan or closing real estate deals. When they're applying for a mortgage loan within 3 business days, we have to give out the loan estimate if we're a lender. Within 3 days of closing, we have to give them a closing disclosure. By the way, the closing disclosure is just the summary of all of the charges finalized so that the consumer can see the final numbers. Now, the loan estimate and the closing disclosure kind of get matched up so you can make sure that the lender was in compliance with their accuracy of disclosure. And that's really it. There's a right of rescission on refinancing and home equity loans, not on purchase loans. That's given a 3-day right of rescission. And then there's some advertising requirements where the lender has to be honest and truthful about advertising, but the APR can stand alone. Cool. All right, the next thing we're going to talk about is something called qualified mortgages, or QM loans. These are loans meeting specific affordability and underwriting standards under the Truth in Lending Act. So we have QM loans that are safe standard loans for consumers. All right, and then we have the next one here is prohibited practices. It includes deceptive advertising and steering consumers into less favorable loans. So Truth in Lending has some consumer enforcement actions. There's something called a high cost loan, which is known as HOEPA. HOEPA is Home Ownership Equity Protection Act. It's a law that we wrote to specifically address high cost loans, loans that are a little bit more expensive than prime loans. See, in our business of lending, there's prime loans, there's high cost loans, and there's higher cost loans. Prime, higher cost, and high cost. High cost loans are specifically governed under this HOEPA law, which sits under Truth in Lending, and it's special protections and rules for loans with higher interest rates and fees. For the mortgage originators, you definitely need to know the trigger points for first mortgages and second, and how it's compared to the average prime offered rate. We'll cover that in another course. But so then we have that. Now, all of these disclosures have to be given out on business days. So a business day definition would be appropriate. What is a business day? It's a day under Truth in Lending, includes all calendar days except Sundays and federal holidays. On the front side, if a bank is open and considered open for business on a Sunday, to give them the loan estimate, the Sunday also qualifies. But a rescission day on the other side, on the back side, is to give the consumer the benefit of the doubt. So business days for rescissions include all days except Sundays and federal holidays. So if somebody's given 3 days right to rescind and they close their loan papers on a Wednesday, well, they're given Thursday, day 1, Friday, day 2, Saturday, day 3, and then the loan can fund on Monday. And so you go and you sort of calculate it that way when you're looking at rescission days, okay? And then there's penalties for non-compliance, and they include things like fines, liabilities for damages, and potential consumer lawsuits, which are all sort of pieces that go hand in hand with the Truth in Lending Act. All right, so that was a quick summation. We're going to take a short break here, and then we're going to come back. And when we come back from our break, we're going to jump into those flashcards, and then we're going to wrap it up with some quiz questions. I'm going to check the feed while we're taking a short break, and we're going to check and see if there's any questions that I can answer for you guys as we're studying. You guys are doing fantastic. Hang in there. Truth in Lending is worth it. It's going to be on this examination. I will see you in just a few moments. All right, we are back, and let's get into some of these flashcards and check them out. So the vocab on exams, certainly things that we want to start to get our hands on, and they'll help you. And I'm sure if you guys are subscribed to the channel, you'll see we have a lot of flashcard videos. By the way, we have a ton of state flashcards coming out for all 50 states, and we're going to be releasing them shortly in succession. I think there's 3 states coming out. Arizona came highly requested, Connecticut came highly requested, and New York. And those are about to be dropped in just a few weeks, something like that. And then we go from there. A little bit about me, by the way. I love to teach. I've been doing this for a long time. It really, really excites me to do this. I've been teaching different subjects, different disciplines for a very long time. I have a lot of background, extensive background in investing, and through law school and all this other stuff. So basically, I've got a lot of stuff that I want to teach people about, and real estate happens to be one of those things. And it really means a lot to me. It's done so right by my family and I, and sort of my love for it, that I'm very passionate about it. And some of the stuff that we've been working on, I haven't taught in a little while. We were doing a lot of writing, a lot of course content creation, and that takes a lot out of one. So to be able, so we've got a bunch of stuff coming out. We've got books on Amazon now. We've got more books coming out. We've got more content, more materials, more stuff, more content that's being built for all kinds of different things. We've got some really, really, really cool mortgage pre-licensing stuff that's about to come out. And with the mortgage pre-licensing stuff, I'm licensed to be able to teach courses in all of the states. So I can, the idea there is to also help folks with their pre-licensing and do that as well. So part of what I do, a huge piece of what I do, is this build content and sort of teach and lecture. And I've been teaching these topics for such a long time. I feel like I just need to help people pass these examinations, move on with their lives, and just sort of get into what they want to do. So my intentions are pure. Along the way, we have have books, we have content, we have stuff, and some of it's free and some of it's for sale, and some of my teaching is free, and some of it's, you have to pay to come and see me. But the intention is always pure. It's to be able to teach. I've been doing it. I love doing it. I have two younger kids, and it really makes me excited when they say, "Hey, what does Dad do?" Dad teaches, and they actually kind of say, "Well, Dad's a YouTuber," which is kind of funny to me. But in any event, again, I really, really appreciate everybody sort of joining and subscribing and liking and comments, and the comments are awesome, and we're reading through them. And it's so cool to watch as people are passing examinations and just moving on. And share those stories, please. It helps me to continue doing what I'm doing. And I appreciate the feedback and stuff. If you have specific things that you'd like me to teach, go ahead and ask. Believe it or not, somebody just asked us for Arizona flashcards. So Kate, who's my business partner, just whipped them together, and she's like, "Go film. You're in the studio." So, and by the way, part of my other thing is I'm a creator, so I do a ton of stuff. I've been doing video and audio for years and years. So for me, this is a lot of fun, and I rather enjoy doing the production side of it too. All right, let's get into some vocab, and I'm going to do this sort of flashcard style, and we're just going to run through these. The first one is what TILA is, the Truth in Lending Act. TILA is a federal law that requires lenders to provide borrowers with clear and accurate information about the terms, costs, fees, and conditions of a loan, including the annual percentage rate and repayment terms. Prohibited practices. Prohibited acts under TILA include misrepresenting loan terms or costs, failing to provide required disclosures, charging excessive fees or interest, and steering borrowers towards loans that are not in their best interests or financial gain. Additionally, TILA prohibits deceptive advertising, unfair servicing practices, and imposing prepayment penalties on certain high-cost or qualified mortgages. And we looked at qualified mortgages a little earlier. We defined them basically, and we also talked about high-cost loans or HOEPA loans. Regulation Z. Remember I told you that sometimes they'll refer to Truth in Lending as Reg Z. Regulation Z is a part of the Truth in Lending Act. It was established by the Federal Reserve Board to implement the TILA Act in order to protect consumers by requiring clear disclosures of key terms and costs of lending agreements, including interest rates, fees, and other charges associated with credit. HOEPA. HOEPA is the Home Ownership Equity Protection Act. HOEPA is a federal law enacted in 1994, don't worry about the date here, as an amendment to the Truth in Lending Act. It was amending the Truth in Lending Act. It was designed, here's what you want to know, it was designed to address abusive practices in high-cost home loans, such as predatory lending and excessive fees. Loan estimate. The LE is a document provided by lenders to a borrower that includes an estimate of the monthly principal and interest payments, along with other loan terms such as the interest rate, loan amount, and estimated closing costs. Closing disclosure, also known as the CD, is a detailed document provided to the borrower by the lender that summarizes the final terms and cost of the mortgage loan, ensuring transparency and compliance with lending regulations. Annual percentage rate. The APR is a standardized calculation that reflects the total cost of borrowing, including both the interest rate and any fees associated with a loan, including any prepaid interest points. Now remember, don't forget that we can advertise APR absolutely we can advertise APR clearly by itself. Everything else is going to trigger further clarification. They're called trigger terms. Further clarification in order so that the consumer is clear on what they are receiving, okay? Except APR can stand alone. Right of rescission. This established under the Truth in Lending Act, the right of rescission gives borrowers the ability to cancel certain refinance home loans or lines of credit within 3 days after signing the loan agreements on their primary residence. That's another thing that I want you to remember, that the right of rescission applies to your primary residence, not for investment properties, not for that kind of stuff, okay? Just for your primary residence where you're legally domiciled, primary residence, okay? Or lines of credit within 3 business days after signing the loan agreement on their primary residence. This quote unquote cooling off period is designed to protect consumers from making rushed financial decisions. You're way more market aware right before or after you've done something than sort of leading up to that something. And in the financial markets, that helps consumers going, oh, you know what? I completely whiffed here. I should have, I just found a cheaper lender. I just found something better that would suit me better, which gives you the ability to back off. The average prime offer rate. Now, for my real estate students, you do not have to worry about APOR. For the mortgage originators, I would want to know what this is. All right, so APOR, the average interest rate that the most creditworthy borrowers in the market qualify for. Finance charge. The total cost of a mortgage expressed as a dollar amount over the life of the loan, including interest, service charges, mortgage insurance premiums, and any costs or fees associated with taking the loan. Trigger terms. Trigger terms are specific phrases or terms used in advertising that under TILA require additional disclosures to ensure transparency for consumers. These terms must be accompanied by full and accurate financial information about the loan's terms. An example here would be monthly payments as low as $1,200. So that's going to say, hey, well, okay, monthly payments as low as $1,200. Well, what's the catch? And so the additional information in sort of the fine print, I'm sure you've all read fine print, it's like blah, 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 blah. The $1,200 has to be further clarified. But if it says, monthly, it says APRs as low as, 3.172, boom, you can just have that on there and that stands alone. But everything else is going to trigger other terms or further clarification. High cost mortgage. The Homeownership and Equity Protection Act, or HOEPA, is a section of the Truth in Lending Act that targets certain types of loans that are considered high cost, requiring lenders to provide additional disclosures and protections to borrowers. A high cost loan is considered to be one that is 6.5% higher than the average prime offer rate for a first mortgage, or 8.5% higher for a second mortgage. Okay, not sure if you remembered, but earlier in this live lecture, I mentioned that the real estate folks do not need to know APOR and these triggers. The mortgage folks, absolutely. If I were testing you here, I would want you to know that. So for the mortgage folks out there, you definitely want to know what the high cost trigger is. The high cost trigger is if a loan, the cost, if it's considered that if it's 6.5% higher than the average prime offer rate, if it's something higher than on a first mortgage, then it is a high cost loan, which will trigger further clarification, further times, extended rescission periods, etc. Right? That's what that all means. So you don't need to know this beyond that. Real estate folks, don't even worry about the bottom section of this slide here. You can skip it. Qualified mortgage, or QM, is a loan that meets strict guidelines set by the Consumer Financial Protection Bureau under the Dodd-Frank Wall Street Reform Act. It was designed to eliminate risky loan features and ensure borrowers that they have the ability to repay their mortgages. So qualified mortgages are mortgage loans that are safe and have safety standards. They are not high-cost loans. They are lower interest rates. Their financing terms are reasonable and, if not, relatively conservative. So really, at the end of the day, a qualified mortgage loan is a loan that the lender has placed some time and effort into believing or solidifying that the borrower has the ability to repay that. As a matter of fact, for the mortgage students, you're going to learn about the ATR rule, which is the ability to repay rule, which is a piece and sort of goes hand in hand with qualified mortgages. Non-qualified mortgages, or non-QM loans, is a type of home loan that does not meet the criteria set by the Consumer Financial Protection Bureau for a qualified mortgage and is designed to accommodate borrowers who may have unique financial situations that don't fit traditional lending standards. So again, nobody is saying that you can't have a riskier situation, but borrowers and lenders together both want to make sure when it's possible to make sure that things are qualified mortgages, because later for the mortgage folks, you'll learn about something called a safe harbor rule and a rebuttal presumption. And those are pieces that go in for that particular side of it. But for the real estate folks, don't worry about it. You don't need to know much about that at all. Mortgage servicer. The lending company or entity that collects and manages monthly mortgage payments from a borrower. It's who you write your mortgage payment to. It's who collects the mortgage payment every month. Steering. Steering is the unethical practice of guiding borrowers or home buyers towards a particular loan product, real estate agent, or service provider that benefits lenders or agents financially, rather than the one that is in the best interest of the borrower. Steering in mortgage lending is prohibited under the Real Estate Settlement Procedures Act and Dodd-Frank Wall Street Reform Act. So there's a little glitch in this slide, my bad. This is a common phrase that you see across many different types of examinations, simply called a material misrepresentation. You guys want to know what like negligent misrepresentation is, purposeful misrepresentation. So a material misrepresentation, providing consumers with false, misleading, or incomplete information about the terms, costs, or conditions of a loan. Under the Truth in Lending Act, lenders and loan originators are required to disclose accurate and transparent information to ensure consumers can make informed decisions about their loans. So we just want to have a basic framework of what material misrepresentations are. Something that is material in nature is something that is relevant or germane to the transaction that adversely or positively impacts the outcome of a transaction. So you kind of want to understand what that would be, and that's what a misrepresentation is. Sometimes on exams, exam writers might give you examples of misrepresentation, so look out for those. Points and fees threshold. HOEPA, the Homeownership and Equity Protection Act, a high-cost loan thing, defines high-cost loans based on the total points and fees charged relative to the loan amount. Points are costs paid upfront to lower the interest rate, known as discount points. Fees include loan origination fees, application fees, broker fees, and certain closing costs. And again, these fees are rolled into the expression that is known as the APR. So as you're learning what APR is. Now, sometimes, for real estate agents, you do not need to know much more than what APR stands for and the fact that it can stand alone. For mortgage professionals, you want to know trigger terms, you want to understand what points and fee thresholds are, what HOEPA loans are, higher cost loans and the triggers, and everything else, okay? ARM, adjustable rate mortgage. These are types of home loans where the interest rate fluctuates periodically based on market conditions, resulting in changes to the borrower's monthly mortgage payment over time. Prepayment penalties is a fee charged by a lender when a borrower pays off their mortgage early. It compensates the lender for lost interest and is typically calculated as a percentage of the loan balance. Prepayment penalties are regulated under the Truth in Lending Act, TILA, to promote transparency and protect borrowers from unfair lending practices. Periodic Statement Rule. Implemented under Regulation Z, the periodic statement rule requires mortgage servicers to provide borrowers with regular, detailed statements for most closed-ended residential mortgage loans so that the borrower can clearly understand their payment obligations, loan statuses, and any fees or charges. Ability to repay. Remember, this is something that the mortgage originators need to know, not the loan officer, the real estate agents. And the ability to repay is the ATR rule. The ATR rule established under Truth in Lending requires lenders to thoroughly evaluate and verify a borrower's financial capacity to repay a loan before extending credit. This includes assessing factors such as income, assets, employment status, and debt obligations to ensure the loan is affordable and to prevent irresponsible or predatory lending practices. Loan originators compensation rule. This rule prohibits loan originators from being paid based on the loan's terms or conditions, such as interest rates or loan size. Back in the day, before all of this legislation, a loan originator could basically charge kind of whatever they wanted to, and many times they were incentivized to write bigger loans. So the bigger the loan, the more you would get paid. And obviously, the larger the loan that you originate, the larger the commission compensation is going to be, but it cannot be based off of the loan terms and not. It can only be based off of the loan size. So this rule it ensures fair lending practices by preventing incentives that could lead to steering borrowers into less favorable loans. Closing costs. Fees and expenses associated with finalizing a mortgage, including lender fees, title insurance fees, and other transaction-related charges, which must be disclosed under the Truth in Lending Act. And again, a piece of the closing disclosure and the loan estimate are going to reflect these closing costs on those documents, the LE and the CD. All right, awesome. So there's some vocab phrases for you. That's sort of the flashcard segment of this live stream. Let's take a short break here. We'll be right back, and then we'll wrap up this session with a couple of practice quiz questions that we can go through. I'll give you my 2 cents on these, and then we can call it for the day. I'll see you in just a few moments. Welcome back. All right, so the next stop that I want to do here is I'm looking over my shoulder. Just want to make sure everything's working. All right. So the next thing, by the way, I told you I'm flying solo, so you got to cut me some slack if there's a little bit of technical difficulties. I mean, I'm pretty decent at getting this stuff across, but be kind. All right. So we are making our way towards the end of our training. We've been talking all about the Truth in Lending Act. You guys are awesome for lending your ears and visuals. And just, again, keep working on this stuff. Keep studying. Take every opportunity you can. The intention for us is to go live fairly frequently. We're going to try to commit to being able to put out some of these modules to help you get through things, and hopefully to open up live interactions so that you guys can sort of talk to me and ask me questions. And we can go from there. By the way, if you're in the Massachusetts area, we will be posting some classes, limited availability, for me doing them live stream, and we're talking about some live partial engagements face-to-face at certain locations. But we're definitely going to have some more courses posted and stuff like that, sort of getting back into teaching maybe like once a month or so, or maybe once every other month, if you're interested in that. And if you are interested in more content, specific content, and other things, don't forget to reach out to us. Make sure you subscribe, like stuff if you can. If you like it, comment, give us some feedback. Let us know how we can help. And I'm more than happy to do that, depending on what we have. We have X amount of content that we've scheduled that are preordained to being basically put out. But we love hopping on. If there's clarification that you need, I've put out, clarification on questions. Somebody had this happening with that, and somebody had this. So if you want to be able to offer that feedback, that's great. By the way, just a couple of quick disclaimers. Even though I talk about these examinations, I haven't physically taken your examinations. I am licensed with all of this stuff, but however, I haven't taken your examinations. So all of these questions and everything else that I teach I'm making suppositions. I've put myself in this material for years. So my ability to be able to write questions, to understand questions, and coaching people, my barometer is pretty good. My targeting system is pretty accurate with when it comes down to it. But when I say that this is going to be on the exam, or this could be on the exam, or this is potentially on the exam, I have no clue what's on the actual exam. I'm giving you my best take, but my best take is pretty accurate, right? So that's what I want you to understand. So I'm making no claims as to the accuracy of these questions. I'm making no claims as to you're going to see these exact questions on examinations. I can't possibly know what's on these examinations. All right. So just make sure you understand that. I'm not affiliated in any way when I'm teaching these live sessions with CFPB or the Conference of State Bank Supervisors or the NMLS directly or any real estate board or association. None of this is an affiliation of them, and my opinions and my comments and everything else are mine and my own, and I stand by them, but they have nothing to do with Real Estate License Pro, who's my parent company, or anybody else. Just giving you the disclaimer. Now, let's jump into some questions and let's go through it. And what's kind of cool about this live thing is I can kind of give you an analysis of these as we're going through them. So I'll read the question, I'll give you a second to think, and then I'll bang out with the answer. Here we go. Question number 1, what is the primary purpose of the Truth in Lending Act? Letter A, to regulate home purchase contracts. Letter B, to protect lenders from default risk. Letter C, to ensure clear and consistent disclosure of loan terms to consumers. Letter D, to establish underwriting guidelines for FHA loans. The question once again is, what is the primary purpose of the Truth in Lending Act? And the answer is letter C, to ensure clear and consistent disclosure of loan terms to consumers. Now, TILA is all about consumer protection. Obviously, this question made the most sense. This answer is the answer, right? So this is a good one to make sure that you kind of look at how this all kind of comes together. And really, at the end of the day, that is the prime purpose of the Truth in Lending Act. Pretty easy one. Let's go to the next one. Question number 2. Which factor triggers classification of a loan as a high-cost mortgage under HOEPA? HOEPA, again, was the Home Ownership Equity Protection Act, high-cost loans. Letter A, the loan includes a prepayment penalty of more than 1% of the balance. Letter B, the APR exceeds the average prime offer rate by a specific margin. Letter C, the borrower's debt-to-income ratio exceeds 50%. Letter D, the points and fees exceed 5% of the total loan amount. The question again is, which factor triggers classification of a loan as a high-cost mortgage under HOEPA? And the answer? Letter B, the APR exceeds the average prime offered rate by a specific margin. Now, loan officers, I would learn the specific margin. Real estate agents, I would just know this basic sort of framework, and you should be good to go regarding triggering high-cost loans. Question number 3. A borrower refinances their primary residence but decides to cancel the loan 2 business days after signing the agreement. What protects the borrower's right to cancel? Letter A, high-cost loan protections. Letter B, the closing disclosure, CD. Letter C, the periodic statement rule. Letter D, the right of rescission. The question, a borrower refinances their primary residence but decides to cancel the loan 2 business days after signing the agreement. What protects the borrower's right to cancel? And the answer? Letter D, the right of rescission. We just learned this. All right, so the right of rescission, definitely want to know 3 business days, right to rescind. Don't forget, purchase loans don't count. Investor loans, all that other stuff don't count. There's no rescission period. You want to remember it's primary residence. That was one of the triggers in the question. And it's also 3 full business days. We also defined what a business day is earlier in today. So check those out. Right of rescission is definitely something you want to know for your exam. Question number 4. An advertisement for a home loan states low monthly payments of $1,200. What additional information must be disclosed to comply with TILA? Letter A, the loan officer's contact information. Letter B, the loan's APR and total finance charges. Letter C, the borrower's credit score requirements. Letter D, all of the above. An advertisement for a home loan states low monthly payments of $1,200. What additional information must be disclosed to comply with the Truth in Lending Act? And the answer? Letter B, the loan's APR and total finance charges. Many times students pick the all of the above option if they tend to have to cover themselves. Suggestion that I can make is always read the answers first, if you can, before reading the question. It's going to help you tremendously. Sort through and sift through, categorize and understand what the answers are. Then you can always make an idea of what a question really is, and you can sort of define it that way. Sort of reverse engineer things is like what I enjoy doing when I'm studying for an exam or taking something. And it's usually fairly helpful for me to sort through the noise of the question. Now here, the best answer, the loan's APR and total finance charges. As we've mentioned earlier, these have to be clear and conspicuous. And the final question, question number 5, which of the following loan does not provide the borrower with the right of rescission under TILA? Letter A, refinance of a primary residence. Letter B, home equity line of credit or HELOC. Letter C, home purchase loan. Letter D, cash out refinance of a primary residence. Which of the following loans does not provide the borrower with the right of rescission under the Truth in Lending Act? And the answer? Letter C, home purchase loans. Remember, home purchase loans do not qualify under the right of rescission. Every other type of loan here, refinancing of a primary residence, absolutely. Letter B, home equity lines of credit, yes. Cash out refinances of a primary residence, absolutely. Home purchase loans do not have a rescission period. You definitely want to know that for your exam. All right. That covers the Truth in Lending Act in this short live session. I wanted to cover that and make sure that you had some practice questions to check out. Thank you once again for attending the session, and we're going to be doing a lot more of these. So thanks again for all of the subscribers out there and for new folks joining the channel and just checking us out. Thank you. Welcome. We really appreciate everything that's been going on. The channel's been growing by leaps and bounds, and we're very, very excited to see so much growth and activity. Really, at the end of the day, it's all about you. It's all about you learning real estate, the fact that you can pass these examinations. They can be challenging. Don't worry about it. Just hang in there. Keep working. Keep studying hard. Keep focusing. I am very confident in your abilities. It excites me to know that there are so many folks out there getting their licenses and moving forward with life and trying to do the best that they can for themselves and their families. If you need me for anything, reach out, and we are more than happy to train you as best as we can to get that license and get on with your life. Thank you very much, and we'll see you in the next session.